Hi, I'm Trevor Tardif, and I help people buy and sell homes in the Edmonton real estate market. And in this video, I'm going to show you how to calculate how much home you can afford. Okay, so when it comes to calculating how much home you can afford, there's 5 areas that we're going to go into. The first one is lender requirements, then down payments, affordability calculators, credit rating, and the pre-approval process. Now before we get started, if you are serious about buying or selling a home, give me a call. You might want to hire me, you might not. Either way, I'd be happy to give you some advice. If you do want me to point you in the right direction, just go to my website at booktrevornow.com. Let's jump into lender requirements first. So with lender requirements, there's 2 ratios that the banks look at when they're evaluating your ability to purchase a home, as well as how much home you can actually afford. And these are ratios, and the first one is called your gross debt service ratio and your total debt service ratio. I'm gonna go in and explain to you how those work. Don't worry about it too much if you're not comfortable with doing these calculations yourself. Later on in this presentation, I'll show you how you can just get a professional to do it for you. But for those of you that wanted to do a little bit of calculations on the front end, just to get a rough idea, this is a great place to start. So let's start with the gross debt service ratio. So your gross debt service ratio is the percentage of gross monthly income used for mortgage payments, property taxes, and heating costs. And it generally cannot be more than 32% of your gross monthly income. So what does this mean for you? It means that you can only use 32% of your gross monthly income on mortgage payments, property taxes, and heating costs. And just to give you a really simple example, if you were making $1,000 a month gross, 32% of that would be $320. So that means in the bank's eyes, the maximum amount that you could put towards mortgage payments, property taxes, and heating costs would be $320 a month. So you can take your own gross monthly income and figure out what that amount would be. So that's the first ratio that banks look at. The second ratio that they look at is your total debt service ratio. And this is the percentage of gross monthly income required to cover monthly housing costs, which is everything that we just talked about in gross debt service ratio, plus all your other debt payments, such as car loans or leases, credit card payments, lines of credit payments, and any other debt. And it can generally not be more than 40% of your gross monthly income. So if we just continue with the example I gave earlier of $1,000 a month gross monthly income, let's say in this case you've also got a $100 a month car payment. So now you have to take that into account in the total debt service ratio of 40%. So even though earlier in this example I said if you made $1,000 a month that you'd be able to put up to $320 towards your housing costs, now since we're looking at the total debt service ratio, if you've got a $100 car payment, you could no longer fall under that 32% and still fall under the 40% for your total debt service ratio. Because if you went right to the max on 32% on your gross debt service ratio, and then you add that $100 car payment, that would bring you up to $420 a month, which would actually be 42% of your gross income. So that would push you over in this case, and therefore you would not be able to actually use that full 32% because you've got this other debt. So in that case, you would actually be lower on that. You've got to keep your total debt service ratio below 40%. So this ratio brings into account all the other debt service that you have. So if you've got no debt at all, then it's pretty straightforward. You just look at your gross debt service ratio and stay under that 32% and you should be good. But once you've got some other debt, this ratio is going to come into account and it could end up limiting your purchasing ability. Okay. So that covers the main lender requirements in terms of how they look at your ability to afford a home. So the next thing we're going to talk about is down payments. When purchasing a home, the minimum down payment amount is 5% down. So that means, if I'm giving you another example, if you were buying a $100,000 home, that the minimum down payment would be $5,000. And the down payment is the cash you've actually got in hand, the bag of money, metaphorically speaking, that you bring to the table that you've already got saved, which kind of leads into our next point here. So I labeled this as the top 3 ways to get a down payment, but it's more like the top most common ways to fund a down payment, let's put it that way. So the first one is savings. So if you've saved money towards purchasing a home, this is the most common way that people buy a home. They've saved up their down payment, whether it's 5% down or more. The second way is a gift from parents. So if you don't actually have enough money for a down payment, but you've got parents that are willing and able to help you, they can actually go through a process of gifting you the down payment so that you can still purchase a home. And lastly, you can borrow from your RRSPs. So if you've been putting money into your RRSP accounts and it's sitting in there, there is actually a program through the Canadian government where you can take that money out and use towards a down payment. I'm not gonna go into the details of exactly how that program works, but it essentially works as a loan from your own RRSPs that you do need to pay back over time, but there are some advantages to using that program as well. Now, I did say the minimum down payment that you need is 5%. There are some other things that come into play when you're doing 5% that increase your mortgage amount with getting insurance through a company like CMHC. If you put 20% down or more, there is no CMHC fees, but I'm not going to go into details with that. But I just wanted to show you what the minimum was and the three main ways that people do get their down payment. Okay, so next, I wanted to show you affordability calculators. But before we get into that, if you are serious about buying or selling a home and you'd like to get some advice, feel free to give me a call. The easiest way to actually get in touch with me is to go to booktrevornow.com, where you can call or text me, or you can actually just set up a quick time to chat. So in the first section, I showed you the gross debt service ratio and total debt service ratio. If you didn't really want to crunch those numbers yourself, you can actually use an affordability calculator. And this is one of the easiest ways to start crunching numbers without going to a mortgage specialist. And there's a whole bunch of different mortgage calculators and affordability calculators online. But the one I wanted to show you is actually on Realtor.ca. So the way you access this affordability calculator is you go to Realtor.ca, you hover over mortgage calculators, and then you go down and click on affordability calculator. Then you're gonna see a screen like this where you can start punching in your information. So in this example, the annual income, I put $75,000. If you've got a co-applicant, that's actually gonna be if you're like a husband and wife, for example, and you're buying a home together, you put the other person's income in there as well, and this is annual income. Below is where you put your debt payments in, so they're asking for that because that's going to come into play in the total debt service ratio we were talking about earlier. So in this example, I put a $100 a month credit card payment, a $300 a month car payment, and a $50 a month other loan expense payment. On the right over here is the living costs, where it includes property taxes, condo fees, and heating costs. Those go into play into the gross debt service ratio as well that I was talking about. You can actually put your own numbers in here, or you can just get it to estimate it for you. When you're first getting started, it's probably easier to just get them to estimate it for you. After you've filled out that information, then you click this button on how much can I afford, and it will bring you to a screen like this. So there's a couple things you gotta do here. They will actually automatically calculate this first row on the left, max affordability, but they're doing it based on a 20% down payment. So earlier I told you the minimum amount is 5% down, but for a conventional mortgage, the minimum amount is 20% down. And they'll show you, okay, based on your income and your debt service ratio, you could afford a property for $448,059 with a 20% down payment. It'll show you how much the total mortgage is required. It's based on a 30-year amortization. And you can also punch in the mortgage interest rate. I think I did adjust this. You'll want to put in an interest rate based on what you are able to get or what you found once working through a mortgage broker or your bank. At the bottom here, it also does try to calculate your land transfer tax. You do actually have to fill this in at the bottom on your province and city, so it can calculate that for you before it'll actually punch out these numbers. I've shown it to you here after I've filled in a little bit of information, but you are going to want to put your province and city so that it can do it for you. Now, on the right-hand side, this build your own piece, it did not let me edit the down payment amount until I changed the amortization period to 25 years. So you'll want to change that to 25 years. Not sure how come it's got that limitation, but change that to 25 years, and then you can start adjusting the down payment amount, so based on how much you've got. I went and bumped this down just to show you what it would look like on the low end if someone only wanted to do 5% down. They were looking at the minimums. And I adjusted that number until it showed me that it was 5%, which happened to be $17,000. So you can see that it calculated how much home you could afford based on a smaller down payment. Obviously, it's going to come down, so you can play around with this to get an idea on how much you can actually afford based on your income, your debt, and how much money you have available for a down payment. Okay, so once you've done that, that will give you a pretty good idea on how much you can afford just based on some calculations. The next thing I wanted to go into is actually your credit rating, which also plays a very important role in determining not just how much home you can afford, but also if you can actually buy a home right now. So it's very important. So let's go into that. So your credit report. So this is a very good way to start. And what your credit report is it's a summary of your financial history and shows whether or not you've had any problems in the past paying off debts. And you can find out how to order your credit report for free at www.itpaystoknow.gc.ca. Now, once you get to that website, it doesn't actually bring you to the right page. So what you're gonna wanna do once you get to that website is there's a search bar, and just type in free credit there, do the search, and I believe the first result will be the page that you're looking for, and that will tell you how you can go about getting a free credit report. Now, just to save you from doing that, you can actually go to Equifax.ca. That's one of the places that you can get a free credit report. You can also buy a credit report from there. The free way to do it is actually doing it by mail, so you can't get it instantly, whereas if you want to just do it all online, you can buy the credit report for $15 to $25, somewhere in there. So if you really want to go the free route, you can just order it through the mail. Otherwise, you can order it online. Now, what's great about these credit reports is when you do it this way, it does not affect your credit score, and it gives you a good snapshot on where you're at. So that leads into the next thing that I wanted to go to, which is giving you some score guidance. So part of your credit report is actually going to be your score. So I just want to give you a little guidance on kind of evaluating where you're at based on what kind of score you come back with. So if you come back with a score greater than 600, you are more likely to qualify. If you've got a score of less than 600, it's going to be harder to qualify with that score. And if that is the case, if you come in with less than 600, my recommendation is to get in touch with a lending specialist so that they can help you come up with a detailed plan to improve your score. And you can do this straight with your mortgage broker or even your bank, depending on who you go through for getting a mortgage. But making a plan to actually get your credit score back up there, if it's not where it needs to be to qualify, is going to help you get there faster. There's a lot of different things that you can do to help improve your credit score, depending on what's been going on in your credit history and what the problem is. So I recommend, if you've come back with a score lower than 600, going and getting in touch with a lending specialist and making a plan to improve your score. Okay, so that covers what I wanted to talk to you about on the credit rating. And I saved the best for last, and that is the pre-approval process. So before I jump into that, just want to let you know, all these 4 things that I've covered before, lender requirements, down payment, affordability calculator, and your credit rating, you can do all that stuff on your own. I wanted to give you resources so that you could start looking into it on your own if you wanted to. But if you want, you don't actually have to go and look at that stuff on your own. If you want to work with a professional, you can go straight to this step, which is the pre-approval process. So pre-approval is either going through a traditional lender or a mortgage broker and actually getting pre-approved for a mortgage. And they're gonna look at all of that stuff for you. They're gonna look at your debt service ratios. They'll talk to you about what you've got available for down payment. They'll pull your credit. So they'll be able to see all of that information and find out how much you actually can afford, as well as are you in a position to actually buy a home. So I just wanted to talk to you about the 2 different options that you've got here, which is either a traditional lender or mortgage broker. So let's talk about traditional lender. So with traditional lenders, that's typically going to be your bank or credit union. And the main pros of going through a traditional lender is that you've already got a relationship in place. It's probably the bank that you already go to on a regular basis. You've had a relationship for years, and therefore it's going to be quite convenient for you to just go in and start the pre-approval process with them. The second way that you can go about doing this is through a mortgage broker. And there's several pros to going through a mortgage broker. The first one is that they're an intermediary between you and the lender, and they negotiate mortgage terms and a rate on your behalf. So that means that they actually work with dozens of different lenders, including mortgage finance companies, So they've got more options for you. Whereas with a bank or your traditional lender, they're just gonna make you an offer based on the relationship that they have with you. They're not going to look and try to find you the best rate or compare themselves to other lenders. They're just seeing what they can actually offer you. Whereas a mortgage broker, they go around to different lenders and they shop the market for you. Most mortgage brokers don't work with every single lender out there, but they do typically work with dozens of different lenders, and they've got relationships in place. So often I like to refer people to mortgage brokers because they're more likely to get better interest rates and or mortgage terms. Of course, that's not guaranteed. It depends on a lot of factors, but there's pretty much no downside to going through a mortgage broker. Their fees are paid by the lender when your mortgage is signed, so you don't actually have to pay them out of pocket. And it's definitely a great way to look at more options. Okay, so that pretty much covers the 5 steps that you can take to calculate how much home you can afford. If you have any questions, feel free to reach out to me. And if you are serious about buying or selling a home, I'd love to hear from you. You can actually go over to booktrevornow.com. And on that website, you can either just give me a call or send me a text. My number's right on that website. Or you can actually book a time to talk with me for 10 to 15 minutes. And I'd love to give you some advice, whether you're buying or selling a home, whether you decide to work with me or not. It's a great way just to kind of help you out, and I can point you in the right direction. So I look forward to hearing from you guys soon, and we'll see you next time.